What drives stock prices to go up? From the long-term perspective, this question is equivalent to what drives the value of a public company, and more specifically for a rapidly growing company, what drives the growth of a company. In this video, I am trying to locate one or two financial metrics that could explain the essential gauge of factors driving a company to grow in value, and see how these metrics help to find potential stocks. So let's begin with the candidates of the financial ratios. Is ROE one of them? Warren Buffett has spoken extensively about the importance of return on equity or ROE as a key metric for evaluating companies. One of his famous quotes on the topic is, "ROE is the percentage profit a company earns on shareholder equity." In other words, it measures how efficiently a company uses its shareholders' funds. Companies with high ROEs usually have a competitive advantage and can reinvest earnings at a higher rate of return, which can lead to compounding growth in shareholder value over time. Looks like ROE is more of an earning ratio than a growth ratio, and how could it help us to tell the quality and quantity of the growth of a company? Or is there any hidden significant merit related to growth for this most famous metric? Alright, before the exploration, let's rewind a little bit to a fourth-grade arithmetics to explain the source of the growth of stock prices. As we all know, the price of a stock is the product of EPS and PE ratio, or price-to-earnings ratio. As a simple derivation, the change in the price is also the product of the change in EPS and the change in the PE ratio. For example, at the beginning of a year, the EPS and the PE of a stock are respectively $5.20 times, thus the price at that time is 5 times 20 equals 100. A year later, the EPS becomes $5.50, the PE becomes 24 times, and the price would be 132, or 132%, which equals the product of 110% of the previous EPS and 120% of the previous PE. From the long-term perspective, the change in PE is either insignificant or unpredictable compared with EPS. Therefore, let's focus on the change in EPS, i.e., the growth of the company. So, the next question is, how is the growth of EPS derived from ROE? Basically, the growth of a company is closely related to its return on equity, because ROE measures how efficiently a company is using its shareholders' equity to generate profits. A higher ROE means that a company is generating more profits per unit of equity invested. This is an indication of the company's ability to use its resources effectively and grow over time. When a company has a high ROE, it can reinvest its profits back into the business to fuel growth. This can include expanding operations, increasing research and development, or acquiring other companies. When a company grows, it can increase its revenue and profits, which can lead to higher stock prices and increased shareholder value. With that being said, have you noticed that there is a bridge between the ROE and the growth of the EPS? Yes. That is the reinvestment ratio, which is a measure of how much a company is reinvesting back into its own business. It is calculated by dividing the company's capital expenditures by its cash flow from operations, or the percentage of undistributed earnings to all profits earned during a specific reporting period. Given what we have here, the growth rate of the EPS of a company equals the product of the reinvestment ratio and the ROE, i.e., G equals B times ROE. The B here stands for the reinvestment rate. I put the brief derivation here on the screen, and if you are interested in how this argument is derived, please feel free to pause and study it carefully. You can also get a paper on this topic by Googling "The Fundamental Determinants of Growth NYU." Okay, let's move on. Basically, the two parts of the growth rate could be telling the quality of the management of a company from different angles. First of all, the retention ratio or the reinvestment rate, although influenced by the reality of the business model, the industry that the company is in, and the macroeconomic environment, is still a decision solely by the management, and thus a reliable indicator of the willingness, initiative, confidence, or ambition of the management to grow. Meanwhile, from the aspect of ROE, it reveals if the decision of the reinvestment rate is correct and how efficiently and effectively the management is executing. Therefore, we have a combination of two rates to judge the quality of the growth: high reinvestment rate and high ROE. That's perfect, because it indicates an exquisite business model full of opportunities, efficient management with both accurate judgment and execution power, and high growth opportunities. Low reinvestment rate and high ROE. Good, but the management might be a little bit too conservative to grasp the reinvestment opportunities, or the management is right in the reinvestment decision. Besides, the company is rewarding the shareholders by distribution. Low reinvestment rate and low ROE, not good because it is a boring business without opportunities, but the management is struggling to conserve the value of shareholders. High reinvestment rate and low ROE. Run away from this kind of company if this pattern lasts for years, because the management is destroying it. But some growing companies are in this zone when they are trying to expand their business rapidly. The trick here is to keep a close eye on the trend of ROE. Almost all successful companies have experienced high reinvestment rates along with high ROE, and then the transition to lower reinvestment and stable or even higher ROE, such as the ROE monster AAPL, MSFT, GOOGL, and etc. What has to be paid attention to here is the repurchase of stocks frequently leads to negative shareholders' equity and also makes the retention rate of capital fail to stand for the real reinvestment rate. Besides, ROE is volatile by its nature and is inapplicable to young and growing companies with negative earnings. Moreover, since revenue growth contributes more than 70% to the growth of market cap as indicated by this chart presented before, we shift our analysis to the revenue as we usually do and see if there is an alternative financial metric. When revenue is being inspected, a ratio called asset turnover ratio must be mentioned. The asset turnover ratio measures a company's efficiency in using its assets to generate revenue. It is calculated by dividing a company's net sales or revenue by its total assets. The asset turnover ratio is a key performance indicator that helps investors and analysts assess a company's operational efficiency. A higher asset turnover ratio indicates that the company is generating more revenue for each dollar of assets invested. Conversely, a lower asset turnover ratio indicates that the company is less efficient in using its assets to generate revenue. Another related concept is capital expenditures. CapEx or capital expenditures are expenses that a company incurs to acquire or improve its fixed assets, such as property, plant, and equipment, PP&E. Capital expenditures are long-term reinvestments that are expected to generate future benefits for the company, such as increased production capacity, improved efficiency, or higher quality products. I am going to skip all the processes of derivation and get down to the result directly here. When we are talking about the growth of revenue, capital expenditure and asset turnover rate must be examined. While the percentage of capital expenditure to the total asset would be used as an alternative to the reinvestment rate in the ROE version to demonstrate the decision by the management, the change in the asset turnover ratio would replace ROE as an indicator of execution of the company. There is an example that helps us understand the breakdown of revenue growth. Domino's Pizza, the ticker symbol DPZ, is a well-known American pizza chain that has been in business since the 1960s. After going public in 2004, the company faced a number of challenges, including declining sales and negative customer feedback. However, in the years following 2010, Domino's underwent a major transformation that helped it to expand its business and improve its financial performance. One key strategy that Domino's implemented was to invest heavily in capital expenditures to upgrade its stores, equipment, and technology. For example, in 2012, Domino's launched its Pizza Theater concept, which involved remodeling stores to include open kitchens, digital menu boards, and other interactive features. This required a significant amount of capital expenditure, but it helped to create a more engaging and customer-friendly experience, which in turn drove higher sales. The company's asset turnover ratio has generally been strong over the years, indicating that the company has been able to effectively leverage its assets to drive revenue growth. According to the company's financial statements, its asset turnover ratio has consistently been above the industry average for the restaurant industry, which suggests that Domino's has been able to outperform its peers in terms of asset utilization. The correlation between revenue growth and both the capital expenditure and especially the change in the turnover ratio is obvious and thus an excellent tool to predict the future of revenue growth. Just as we could tell from the chart, although DPZ has kept growing for more than a decade, in recent years, its asset turnover has been increasing continuously while capital expenditure as a percentage of the total assets has been decreasing and reached the lowest point since its IPO, emitting a confusing signal on its revenue growth for the upcoming years. Another amazing example of how this model could help investors to predict future revenue growth is Tesla. The change in the asset turnover ratio has been always serving a predictive purpose ahead of a couple of quarters. This chart also tells us that the upcoming quarters might see a little bit slowdown in its revenue growth rate. The last illustration is a challenge for you, my audience. This chart is demonstrating the revenue growth model of a gigantic tech company that had been growing fast for more than a decade by the time it encountered a headwind in recent years. Could you please identify this company and leave in the comment your analysis and prediction of its revenue growth rate for the upcoming quarters using our revenue growth model?